Starting, all attendees are in listen-only mode.
Assalamu alaikum everyone. Good evening, guys. Welcome to day 4 AFM ACCA webinar, practice to pass session. Thank you so much for joining in. So, in today's session, we are covering currency risk management and the interest rate risk management. We will briefly discuss all the relevant stuff of currency risk management. Then we will discuss the interest rate risk management. So let's start with the currency risk management. We are going to discuss knowledge checklist, examples of requirements, common mistakes, and obviously how to score the maximum marks in this topic. We will be covering two questions, one on the risk management, another on the interest rate risk management. One on the currency risk management, other on the interest rate risk management. So let's start with the first one, foreign currency risk management. So this topic includes types of foreign currency risk, economic risk, translation risk, and transaction risk. So you people should know the difference between the economic risk, translation risk, and transaction risk. Examiner often asks the economic risk, especially the economic risk. And examiner may ask the translation risk as well. In one of the past paper question, examiner has tested all of these three type of risk. If I correctly recall the name of that question, the question name was Lignum Company, and examiner has tested the economic risk, translation risk, and the transaction risk. Then internal hedging includes invoice in home currency, matching and netting, and the most important part is here, that is netting. So netting is very important in internal hedging. If we talk about the external hedging includes forward, future, option, and currency swaps. And all of these are tested in the exam regularly. But the most favorite are future and the options. Other knowledge, the theory will be tested. The theory which is regularly tested, that is comparison between the forward and future and option. The comparison between forward, future, and option. Examiner often tests advantage and disadvantage of swap contract. So if you are revising currency risk management, you should cover these three theoretical topics: the comparison between forward, future, and option, the advantage and disadvantage of currency swaps, and the comparison of exchange traded and over the counter derivatives. The comparison between exchange traded and over the counter derivatives. The maximum derivatives which can be tested in external hedging is forward, future, option, and currency swaps. Collar, cap, and floor will be tested in interest rate risk management. So whenever you are solving the future and option, remember you need to follow few steps. So let me explain those steps. So in case of future, in case of currency future, you need to follow few steps. Number one step is you have to identify the amount of currency to be hedged. Amount of currency to be hedged. Second is you have to identify whether you are going to buy or sell future. And remember, this should be according to the contract size currency. Think according to contract size currency. Contract size currency. Okay, we will discuss that. Next is number of contracts. Calculate number of contracts. Next is calculate lock-in rate. And the lock-in rate formula is opening future minus current spot minus opening future current spot into remaining months divided by total months. Into the remaining months divided by the total months. Once you are able to calculate the lock-in rate, that means you have done the maximum part. Then you will write the expected receipt or payment. Expected receipt or payment converted at lock-in rate. So guys, future is very simple. You have to follow these steps. Number one is identify the amount of currency to be hedged. Number two, identify the buy or sell future. You can add another contract, identify settlement date, whether it is a March contract, June contract, September contract. Then you will identify number of contracts and then you will calculate the lock-in rate. This lock-in rate formula is different. Try to memorize this formula. It will be applied in every question where currency future will be tested. This formula will be applied in every question whenever currency future will be tested. Current spot rate will be given. Don't worry about it. Current spot rate will be given, opening future will be given. So lock-in rate will always be calculatable. You can calculate the lock-in rate. Then the last step will be convert the expected receipt or payment at the lock-in rate. That's it. Opening future means the current future price which you have selected here. The current future price which you have selected here. Which you have selected in part B. Examiner is examiner can use the other method to calculate the lock-in rate. Don't worry about that. But this method can be applicable. You can use this method, and this method will be applicable in every question. Lock-in rate and closing future both are not same. I'm talking about the lock-in rate. Remember one thing. In currency future, you will always calculate lock-in rate. You will not calculate the closing future. However, in interest rate question, you will be calculating the closing future. Okay, one of the question is, in some question there are no spot rates. There is, examiner has never tested any question where spot rate is not given. I have written the current spot, not the closing spot. I have written the current spot, not the closing spot. Okay, don't worry, you will not be confused today. I will end the confusion. Okay, now let's quickly revise the option steps. Let's quickly revise the option steps. Currency options. Number one step, identify the currency to be hedged. Okay, one of the student is asking what is the difference between closing future and lock-in rate. I will explain this while solving the question. Identify the currency to be hedged. Next is identify call or put option. If you want to buy the contract size currency, call option. If you want to sell the contract size currency, put option. You have to think according to the contract size currency. Think according to contract size currency. Okay, number 3 step. Identify settlement date. Number 4 step. Number of contracts. Number 5 step. Calculate premium cost. Calculate premium cost. Number of contracts into contract size into premium. Number of contracts. And then you will decide to exercise the option and calculate expected receipt or payment. And in working, you have to solve under overhedge. Under overhedge working. So question, these are 6 steps. First 5 steps are very easy. Only technicality you will face in step number 6. But if you think and then apply, you can do the step number 6. It's not that difficult. Okay, I will explain these all steps with the help of question. So guys, forward is easy. I have explained the future steps. I will cover it in detail in few minutes. I have explained the option step. I will explain it in detail in few steps. Currency swaps will be dependent upon the interest rate swap. So we will discuss in that portion. Okay, now please note down, please take a screenshot of this slide. Whenever you are going to exam, you have to prepare this theory: comparison between forward, future, and option, advantage and disadvantage of swaps, comparison of exchange traded and over the counter options. Okay, let's move to the next step. I will be covering all these questions while solving the past exam paper. I will answer these questions. These are the common requirements. Look, the comparison between exchange traded derivative. So here there is a question about the options. Discuss the benefits and drawbacks of company using forward contract compared with over the counter option. So remember, simple theory from the comparison of forward and option. And then why company prefer to use exchange traded derivative. So you have to prepare this theory. Mark to market process is very important. This has explained in the technical article. An examiner often tests this mark to market calculation. Over the counter currency option has been tested in the past exam paper, and you have to use different derivatives to calculate the expected receipt or payment. This has also been tested in many past papers. All of these notes are available. All of these notes will be available. So what are the common mistakes? I have seen many students make mistakes in simple currency conversion. You should know how to convert the currency. I have seen many students make mistakes in basis risk or remaining basis calculation. So guys, you have to learn this in today's lecture. You should never repeat this mistake. So please, I am highlighting this. We will be learning this today. I have seen many students which lack in lock-in rate calculation. So you will be learning how to calculate the lock-in rate. Then currency swap structure, you should know how the currency swap structure can be made. It depends upon interest rate swap. Even if in today's lecture if we are able to cover these currency swap or interest rate swap, I will make one video available to you guys on the interest rate swap, and by watching that video your concepts will be clear. Okay, students often fails to write the assumptions of future and option. So you should know the comparison between the future and option. Insufficient knowledge of theoretical material. Guys, theoretical material is very simple. You should know the comparison between the currency and you should know the comparison between forward, future, and option. You should know the difference between OTC and over the counter, and you should know the advantage and disadvantage of swaps. So these are the common mistakes. So what you should do in order to score the maximum marks, this is all the same points which I always keep on telling you, that you should have the thorough understanding of the knowledge. You should elaborate all the steps, because every step carry 1 to 2 marks. If you are unable to call any step, take assumption, move to the next topic. You will get full marks for the next topic. After calculation, always discuss the result of the calculation. If you able to solve forward, future, and option answer, remember you should compare these answers, so in order to get the maximum marks. Learn to discuss the advantage and disadvantage of all the derivatives. Try to solve unseen question without referring to the solution. And these are the same points which I keep on telling you, that always read the theoretical expression of the examiner so that you can learn that how to write in the exam. Solve maximum past paper question for practice, but do expect different scenarios in exam. So guys, let's do one question and I will explain all of these steps again with the help of that question. I will explain all of these steps again with the help of that question. So please open March-June 2021 past exam paper. March-June 2021 past exam paper. March-June 2021 past exam paper. Okay, one of the student is asking about the Monte Carlo simulation. If I unable to cover that, do contact me. I will explain you. Don't worry about that. Okay, so next question. Yes, this is the question. Please open this question. Question number 3 of the March-June 2021 attempt. Number 1 step is advise G company on and recommend an appropriate hedging strategy for its US dollar cash flows on 31st August. So on 31st August, you are going to receive or pay some US dollar cash flows. You have to hedge that amount. B part, discuss the advantage and disadvantage of G company in using exchange traded currency options compared with using over the counter currency options. So discuss the advantage and disadvantage for G company in using exchange traded currency option compared with using over the counter currency option. So you have to simply write the advantages and disadvantage of exchange traded options with over the counter currency options, and you have to relate it with the scenario because examiner is asking from the perspective of this company. Then the last is discuss the role of G company treasury function in relation to the management of economic risk. So 10 marks theory and 15 marks numerical has been tested, and this 15 marks also include few marks on the theory, because once you able to get the numerical, you have to discuss the result. So let's open the scenario. Let's open the scenario. G company is an electrical equipment manufacturer based in Malaysia, looking to develop its operation abroad. So you are based in Malaysia and you want to you are looking to develop operations abroad. One of its biggest sale market is the USA, and G company also import components from the US. So you are selling products to the USA market, you are also importing products from the USA market. G company regularly hedges transaction in foreign currencies. It is currently 1st May. It is 1st May. Okay. And on 31st August, G company is due to pay. Due to pay means you are paying, you have to pay. It's a payment, 14.5 million. And receive 37.4 million from the American customer. So you are going to receive 37.4 million, and you are also going to pay 14.5 million. 14.5 million. So payment is 14.5 million, receipt is 37.4 million. So it's a case of net receipt. Net receipt. Spot rates are given based on US dollar over Malaysian ringgit. 4-month forward rate is given. Currency future is given. Contract size is 500 million ringgits. Future price is given in dollar over MR. June and September prices are given. Obviously, we are going to receive amount on 31st August. So we will be using the September contract. Currency option contract size is given 500,000 MR. Quoted price is dollar over MR, and premium is given in cents over MR. Cents over MR means you have to divide with 100. Exercise price is given. Call and put options are given. Future and option contracts mature at the month end. The number of contracts to be used should be rounded to the nearest whole number in the calculation. If the amount cannot be hedged using exact number of future or option contract, the amount unhedged or overhedged should be hedged using the forward market. So guys, you have to take care of unhedged amount. For example, if number of contracts are 20.2 and you are taking 20 contracts, you have to hedge that 0.2 contract as well using the forward contract. For the purpose of the calculation, it should be assumed that options are exercised. Remember, in currency, option will always be exercised because closing spot will not be given, and you will always be assuming that option will be exercised. Next is the second exhibit. The head of G treasury function gave a presentation about the treasury function and what it does to manage foreign exchange risk at the last board meeting. Directors have subsequently raised two questions. Number one, the marketing director has asked whether G company should consider using over-the-counter currency option to hedge exchange rate risk. So this is belong to the B part where you have to discuss the advantage and disadvantage of over-the-counter and exchange rate derivatives. Last point is a new non-executive director has stated that he understands what the treasury function does in relation to the management of transaction risk, but is unclear on the treasury function role in the management of economic risk. So you will be explaining that what is the role of treasury manager in the analysis of economic risk. So we will be solving, this is the C part, we will be solving this shortly. So let's solve for the A part, that is advise G company and recommend an appropriate hedging strategy for the US dollar cash flow on 31st August. So let's open the spreadsheet. Please open the spreadsheet. Let's solve this. Okay, part A, let's solve the part A. Let's solve the first part. That is forward contract. Forward contract. So let's solve the forward contract. Okay, company is due to receive 14 point, company is due to pay 14.5 million and company is due to receive 37.4 million. So before forward contract, let's calculate the net receipt. Net receipts. Payment is 37.14.5 million. And receipt is 37.4 million. So net receipt is 37.4 million minus 14.500. This is 22.9 million dollar receipts. 22.9 million. Okay, now let's solve it with a forward contract. Forward contract. Forward contract is, it's a case of net receipt. So you will be dividing with 0.2374. 0.2374. 4 months forward rate. USD over Malaysian ringgit. 0.2374. 0.2374. Expected receipt will be, this is dollar divided by this. Expected receipt will be 96.46 million. MR. Okay. Which rate for receipt or which rate for payment? It's very simple. Always consider yourself in adverse position. As you know, this is the case of dollar and rate is given in dollar over MR, right? So you need to convert dollar into MR. So you have to divide with the rate. This foreign currency is net receipt. Net receipt is in dollars. Rate is given in dollar over MR. You have to divide it. And whenever you are going to divide, always divide with a higher rate. Higher rate is 0.2374. Higher rate is 0.2374. In case of receipt, you have to divide with a higher rate. Remember the rule. For receipt, divide with higher rate. This is universal rule. This is not my rule. This is universal rule. For payment, divide with lower rate. Okay? And for a multiplication, it is opposite. For multiplication, it is opposite. Do not think in the counter currency type. Rate is dollar over MR. It's dollar over MR, right? And the foreign currency is also in dollars. That's why you have to divide. Okay? Clear? Remember this rule. Whenever you are calculating receipt, for division you will divide with the higher rate. Whenever you are calculating payment, divide with the lower rate. And for multiplication, it is opposite. For multiplication, it is opposite. That is, multiply with lower rate. Multiply with higher rate. What is the concept behind this? Always consider yourself in adverse position. Always consider yourself in adverse position. That is it. Okay. For please, you can take the screenshot of this because I am raising this. Money market hedge is hardly tested because money market hedging was a major topic of financial management F9. So it will not be tested frequently. So guys, next is future contract. Future contract. Adverse position means in case of payment, you will have to pay more. In case of receipt, you will be receiving less. Adverse position means in case of payment, like for receipt, what will be the meaning of adverse position? You will receive less. Obviously, if you divide with higher rate, you will be receiving less. If you are multiplying with lower rate, you will be receiving less. For payment, adverse position means you have to pay more. You have to pay more. Pay more means you will divide with a lower rate. Pay more means in case of multiplication, you will multiply with a higher. Always consider yourself at adverse position. Okay. Or if you want to remember few points like import, payment, expense, Loss in all these cases, divide with lower. Remember that export, receipt, income, gain, in all these cases, divide with higher rate. And for multiplication, it will be vice versa. Okay? These two rules will never disappoint you in AFM. It will be applicable everywhere in AFM. Okay? So guys, I'm raising this. If you want to take the screenshot, please take. Okay. This is the case of receipt. By the way, this is net receipt. This is net receipt. So in net receipt, if we are dividing, we will be dividing with the higher rate. In case of receipt, we will be dividing with the higher rate. This is the case of receipt, right? So for the case of receipt, we will be dividing with the higher rate. Two rates were given. 0.2374, 0.2370. Receipt divide with the higher. Payment divide with the lower. It is that simple. Okay, let's solve the future contract. So I have explained the steps. Identify the amount of currency to be hedged. Identify the amount of currency to be hedged. Amount of hedging. That is receipt USD, 22.9 million. 22.9 million. Second step, buy or sell future. Contract size is given in MR. So you have to think in MR. This is the case of dollar receipt. That means you are sitting in Malaysia. You will be receiving dollars. You will be selling the dollars. You are sitting in Malaysia. You will be receiving dollars. So you will be selling the dollars. But contract is in MR, in ringgit. Contract is not in dollars. So that means if you are selling the dollars, you will be buying the MR. You will buying the ringgit. So it's MR by future. MR by future. Guys, whenever you want to identify whether you are going to buy or sell future, always think according to the contract size currency. Always think according to the contract size currency. If you are selling the dollars, as you are sitting in Malaysia, you are receiving dollars, what you will do with the dollars? You will sell the dollars. When you sell the dollars, you will buy the MR. So that's why it is MR by future. MR by future. Which contract? September contract. September contract. At what price? USD over MR. At what price? Price is given here. Price is 0.2378. 0.2378. 0.2378. 0.2378. 0.2378. This is September contract. Okay. Now calculate the number of contracts. Number of contracts. you will be dividing foreign currency with the spot rate. Formula is, number of contracts formula is amount divided by contract size. So the amount is in dollars, contract size is in MR. So you have to convert the dollars using the future rate. Using the future rate. So convert the amount using the future rate. So I'm using this. Convert the amount using the future rate and then divide with 500,000. 500,000. So 192.60 is the number of contracts. So you will write it as rounded off. 193 contracts. 193 contracts. So contracts will be 193. 193 contracts. Next step will be, after the number of contracts, next step will be lock-in rate. Calculate lock-in rate. Calculate lock-in rate. Okay. Try to use this formula. First of all, let's solve here. What is the opening future? Opening future means current future. What is the opening future? Opening future is 0.2378, which you have identified above. Which you have identified above, 0.2378. This one. This one, 0.2378. Minus the opening future, that is 0.2378. Minus the current spot. Okay, let's move to the question. What is the current spot? Current spot is 0.2358. 0.2358. Sir, why are you using the higher rate? Because it is a case of receipt. In receipt, you will always divide with the higher rate. It's a case of receipt. You will always divide with the higher rate, 0.2358. So 0.2358. 0.2358 into remaining months. So write the date here. What is the today's date? 1st May. What is the future date? 30th September. So how many months are there? May, June, July, August, September. Total months are 5. Total months are 5. But are you going to close your position on 30th September? No. So when you are going to close your position, look at the question, when you are going to close your position, 31st August. So if you are closing your position 31st August, how many remaining months are there? How many remaining months are there? 1. Only 1 month is remaining. So please calculate the lock-in rate. It will be equal to 0.2378 minus 0.2358 into 1 divided by 5 minus 0.2378. 0.2374 is the answer. So whenever you are using this rate, whenever you are using this formula, and you will be always able to calculate the lock-in rate. The signs are intact. Sign will not be changed. These signs are intact. It will not be changed. It will not be like positive or negative or any other thing. It will be same for any movement. It will be same for any movement. Can we use a June future rate instead of May rate? That is another way of calculating the lock-in rate. I'm not explaining that way. I'm explaining the one typical way. Examiner normally calculate lock-in rate by the movement between the two rates. That is another way. So guys, please try to remember this formula. It will never disappoint you. That is my guarantee. Opening future means current future, which you have identified above. You have written that. minus opening future, you have written that current spot, it will be given in the question, into remaining months divided by the total months. How will you able to identify the total months? Write the date of current spot, 1st May. Write the date of future, 30th September. So count the months that are 5. How many months before you are going to close the contract? 1 month before, because you are going to close at 31st August. So let's write it here. 0.2378 minus 0.2378 minus 0.2358 into 1 divided by 5. Answer is 0.2374. Do not, if you are using this formula, it will automatically take care of the trend. You do not have to think that whether the trend is rising or falling. It is that simple. So I am actually helping you out that there is no need to think about the trend. If trend is increasing, this formula will take care of it. If trend is decreasing, this formula will take care of it. Okay? So guys, this is 0.2374 is the lock-in rate. That's how you will solve in the exam. If it was a normal question, you simply calculate the expected receipt in this way. Expected receipt in this way. By dividing 22.9 million with this rate. If it is a normal question. But here, question will be solved in a slightly different way because the examiner has asked to take care of under hedge overhedge amount. But normally we do not calculate under hedging overhedging in the future contract. But here in this question, examiner has asked us to calculate. This formula will be applicable in all of the scenarios of currency future. Currency future. Only in currency future. In interest rate future, it will be used in a slightly different way. I will explain in the second half of today's session. So guys, how to solve today's question? You will not be solving in this way. The expected receipt will be solved in a different way. So let's calculate expected receipt in MR. How many contracts you have bought? 193. And each contract carries 500,000. So you will be receiving 96.5 million. You will be receiving 96.5 million. Give me 1 minute. I will explain what is lock-in rate. I will explain. Don't worry about that. Expected receipt is 96.5 million. But guys, we have done some under hedging. So let's solve that under hedging here. What you have done the contract. The contract is you will buy the MR. You will buy the MR from the exchange and you will provide the dollar. So payment to the exchange is payment to exchange. If you are receiving the MR, that means you will have to deliver the dollars. How many dollars? 96.5 million MR into 0.2374 at the lock-in rate. So you will be paying 22.909 million to the exchange. Payment to the exchange. but your actual receipts are 22.9 million. You have to pay 22.909 million, but your actual receipts are 22.9 million. So the shortfall is, let's calculate the shortfall. Shortfall is 9100. You have to deliver 22.909, but you only have 22.9 million. This is overage. This is overage. So what you have to do, you have to buy this 9100 from the market. Buy balancing amount at forward. So if you are buying this amount, that means you have to pay. And for payment, which forward you will use? 0.2370. Guys, now you have to buy the 9100. Now you have to buy the 9100. So you will be buying at 0.2370. At 0.2370. Is equal to 9100 divided by 0.2370. So the net payment will be, the upper cell is the receipt, below is the payment. So the net receipt will be 96.46 million. Net receipt. So this is the answer, 96.46 million. Why I am solving in this way? Because examiner has asked us to take care of under hedging, over hedging amount. Examiner has asked us to take care of under hedging, over hedging amount. Let's assume guys, please, next 5 minutes are very important. Listen carefully. Let's assume if nothing is mentioned in the question about the under hedging, over hedging. Let's assume if nothing is mentioned in the question about the under hedging, over hedging. So how are you gonna solve this? You simply have to solve in this way. Expected receipt, convert the foreign currency at the lock-in rate. That's it. 96.46 million. You do not have to solve all of these steps. But unfortunately, in this question, examiner asks us to calculate the under hedge or over hedge amount. If we look at the formula, we have over hedged. Instead of 192.60, we have over hedged. We have hedged 193 contracts. So how to calculate the expected receipt? We have booked 193 contracts. One contract has a size of 500,000 MR. So 193 into 500,000. So you will be receiving, by future means, you will be receiving 96.5 million MR. So guys, if you are receiving 96.5 million MR, so that means you have to pay to the exchange in dollars. At what rate? At the lock-in rate. So 96.5 million into lock-in rate. So you will be paying 22.909 million to the exchange. But in actually, you are receiving 22.9 million. You are receiving 22.900, but you have to pay 22.909. So the shortfall is 9100. So guys, you have to buy this 9100 from the market at the forward. And if you are buying something from the market, you will be dividing with the lower rate. So that's how you are going to solve this. This buying amount is a negative. So that's why I have deducted 38,000 from the 96.5 million. So that's how you will solve. So whenever you have to solve using the under hedging, over hedging contract, you will solve in this way. So how to remember that? Remember, if you are buying MR, so you will quickly write here in the home currency. 193 contract, one contract has 500,000 size. So that means you are receiving 96.5 million MR. Obviously, if you are getting MR, you have to deliver the other currency. At what rate? At the lock-in rate. So you will be delivering, you will be paying, you will be giving 22.909 million to the other party. And from where you will receive that amount? From the foreign customer. So you are receiving 22900, but you have to pay 22909. So you are short of 9100. So how you will cover that? You are going to buy this amount at the forward rate. And so two forward rates are given. Which rate we will choose? We will choose the lower rate because it is a case of payment. Always divide with the lower rate. And the net amount is 96.46 million. If question is silent, examiners usually round down the contracts because it is normally easy if you round down the contract. Examiner normally round down, but it's totally acceptable. You can round up, you can round down. It's not that material. Okay. Now let's solve the option contract. Currency option. So the first step is same. Amount of currency to be hedged. B5. So guys, if you are buying the future, that means you will buy the call option. MR call option. There is no need to think again. If you are buying future, that definitely means you are buying call option. Call option means right to buy. Call option means right to buy. So second step is buy option. Okay. What is the third step? Identify settlement date and number of contracts. So settlement date is call option and September contract. September contract size is MR. September contract. September contract. 0.2368. September contract. Point 2368. Okay, now number of contracts 22.9 million divided by 0.2368 and then divide with 500,000. 193.41. So we will write it 193. Round down the contract. It will be under hedging. Round down the contract. Okay. Next is premium. Premium cost. So the premium of September contract is 0.14. 0.14. And it is given in cents over MR. Cents over MR. The formula is number of contracts into contract size into premium. Number of contracts are 193 into 500,000 into 0.14 over 100. 135,100. And it will be in It will be in dollars because number of contract has no sign, 500,000 has a MR sign, and 0.14 is given in dollar over MR. So answer will be in dollars. So this will be the premium in dollars. USD. So now calculate premium in MR. So how to calculate, how to convert the premium? Premium is expense, right? Premium is the cost. Please tell me, will you divide it with higher rate or lower rate? Premium is a cost, expense. Will you divide it with higher rate or lower rate? We should pay. Yes, we have to pay. Excellent. We have to divide it with lower rate. Lower rate is 0.2355. 2355. 0.2355. Okay. Now you will decide. Always you have to write this statement. You will always be writing this statement. It is assumed that option will be exercised. You will always take this assumption. It is assumed that option will be exercised. Okay. If you are assuming that option will be exercised, will you calculate answer in foreign currency or home currency? Please tell me. Will you calculate answer in foreign currency or home currency? Home currency, right? So answer should be in home currency. Excellent. Okay. There was one question, sir. Previously, why did you write 0.2368? 2368 is the excise price. It's not the spot or something else. It's the excise price. Strike price. 2368 is the strike price. That's why I've written strike price here. Okay. Okay, guys. Whenever, please listen carefully. Whenever you write this statement, that option will be excised. Whenever you write this statement, that option will be excised. Go to step number 2 and identify what contract you have entered. So let's move to the step number 2. We have entered into a contract that we will receive MR. Whenever you write this statement, that option will be excised. Immediately move to the step number 2. What contract have you done? Sir, we have entered into a contract to buy, to receive MR. Whenever you write this statement in exam, that option will be excised. Quickly move to the step number 2. What contract have you done? Sir, we have entered into a contract that we will receive MR. Call mean receive. Okay. Receipts. We have entered into how many contracts? 193. 193 into 500,000. So expected receipt will be 96.5 million. 96.5 million. Okay, in order to receive this home currency, you have to pay the foreign currency, right? You have to pay the foreign currency. Expected, you have to pay the foreign currency. Payment to exchange. If you are receiving home currency, that means you will be paying foreign currency. How much you will pay in foreign currency at the strike rate? You will be paying foreign currency at the strike rate, which you have locked with the other party, with the exchange. So you are going to pay 22.85 million. How much you are receiving? How much you are receiving? Sir, we are receiving 22.9 million. We are receiving 22.9 million. So if you are paying 22.85, you are receiving 22.9 million. So what is the balancing amount, excess amount, which you have received, excess amount? 22.9 million minus 22.85, 48,800 is the excess amount which you have received. So what you are going to do? You will sell this excess amount at forward. Sell excess amount at forward. So if you are selling this excess amount at forward, please tell me, if you are selling at the forward rate, will you divide at the higher rate or the lower rate? If you are selling this amount, will you divide with the higher rate or the lower rate? Higher rate, 74. Then write the premium cost here. And now calculate the net receipts. That is receipt minus payment. 96.131 million is the net payment which you are going to pay. Okay. Okay. 96.5 million. Let's move to question again, guys. Whenever you are solving currency option question, whether it is an old question, new question, average question, difficult question, in currency option, you will always assume that option will be exercised. Okay. Write the home currency here and move to the step number 2. If it is a call option, that means you will receive home currency. If it is a put option, that means you will be paying the home currency. So MR call means you will receive call. So you will receive MR. So I have written 193. We have booked 193 contract. Each contract has a size of 500,000. 193 into 500,000. So that means I will be receiving 96.5 million. 96.5 million. So 96.5 million MR you will be receiving from the exchange. Obviously, in order to receive this amount, we have to pay the other currency, right? If you are receiving MR, you have to pay the other currency to the exchange. So at which rate we are paying the other currency? At the strike rate. If we are receiving 96.5 million MR, we will be paying dollars to the exchange at strike rate, at exchange rate. So that means if you are paying 22.85 million, how much you will receive from the foreign customer? 22.9 million. So you are receiving excess amount of 48,800. Sell that excess amount at forward rate, deduct the premium cost, net amount will be 96.13 million. It's a case of receipt, so why we are doing in both payment and receipt in currency options. Option will be solved In this way, just whenever you write the statement that option will be exercised, it's a matter of just 1 minute that try to think that if you are exercising the option, which currency you will receive. MR call mean you will receive call, you will receive MR. 193 into 500,000 you will receive MR. 96.5 million MR you will receive. In order to receive MR, you have to pay the other currency at the strike rate. Okay, if you are paying 22.85 million, how much you are receiving? 22.9 million. Okay. There are other ways to calculate under hedging, over hedging. There are other ways. But this way will always work. There are other ways. But guys, this way will always work. Any question? Any question from the options? But the net answer is same, right? By the way, examiner has also solved in this way. But examiner has solved in one line and I have used 3 lines. That's why you are thinking that it is a different way. Yes, if there is if normally in option overhedging, underhedging will always be involved. Normally in option overhedging, underhedging will be there. Okay, how I have calculated the premium cost? It has a formula. Number of contracts into contract size into premium divided by 100. Number of contracts, it has a formula. Number of contracts into contract size into premium cost. Answer will be in foreign currency. I have to divide with the local currency. I have to divide with the exchange rate to convert into a local currency. So 573 is in a local currency. Why we are dividing by 100? Because it is given in cents over MR. Cents over MR. Okay. Right? Premium are premium normally you can say 99% chance are there premium will always be in cents. It will be divided with the 100. I have not seen any question where you are multiplying with 100. It is always either it is in percentage or in cents. Okay, guys, now let's discuss. Forward contract is 96.461 million, right? Future contract is 96.461 million 603. Which one is better? Forward contract is slightly better. Forward contract is slightly better. And option contract has the lowest answer, 96.131 million. So you can advise here, even you can advise here in the spreadsheet. You can write a recommendation or you can write the advice. Forward contract has the highest expected receipts, although it is marginally over than future answer. Forward contract, write like a paragraph. Do not write in a single cell. Forward contract is better compared to future because exact hedging and no basis risk is involved. Okay, you just have to compare, and forward contract is better than the future because in forward you will do the exact hedging and obviously no basis risk will be involved here. Forward contract has a problem of default risk, but that can be covered if you if company if G company